Hey guys, Boris last week from BK. We're back from Vegas, ready to roll. What an amazing week in the markets this week with tremendous amount of turns and reversals in the euro dollar at the end of the week. Huge amounts of opportunity for short-term trading. And this week's lesson is going to be very much on ultra short-term trading. Many of you are very familiar with my round number setup, where we're basically trying to trade round number levels, either taking the break or moving towards the break with various amounts of risk-reward parameters. This time I want to show you an ultra short-term risk-reward parameter trade that may not be right for everybody, but I think is very much worth considering for your repertoire of trading, because obviously it's so short-term that it's almost laughable. But on the other hand, the high probability nature of the setup makes it very, very attractive on a longer term basis. What I've been doing recently is I've been taking my round number setup, and this is, for example, this is the euro dollar 143 right after the NFP's print. So we have a positive NFP print, a knee-jerk reaction on risk assumption to the upside, then suddenly a realization that, hey, maybe this is good data for the US and actually negative for the euro, and a complete reversal, takeout of all the levels in the euro. This is one of my favorite setups because a reversal of the initial move usually will always break the key level. In this particular case, it's 4,300, the key level. The difference is I've been trading it ultra cautiously. Instead of simply taking like 43 with a plus 10, minus 10 position, I've actually been taking plus 5, minus 10 on any of the breaks of the round number. And while this may seem almost laughably small, it also produces much higher probability trades. And the reason why is you have to really think about what you're doing. Remember, we're trading very short-term setups. We're trading with a spread very much against us. So in order for us to, for example, make a 10-10 trade, it has to go minus 8 against us in order for us to survive the trade, and plus 12 all the way into the 80s in order for us to take, like, for example, the 4,300. So it breaks 4,300 to the downside. It has to go all the way to 88 offered before we can make plus 10. What I found doing a lot of trading on this type of a setup is that I was correct on my direction, but not nearly as correct on my profits, because it wasn't quite reaching a lot of my profits. Sometimes it would just simply touch the 43 level and come back down. So by giving yourself only 5 points of reward, you really maximize your chances of getting the target profit hit. So if you're trading plus 5, minus 10, clearly a very negative risk-reward ratio, but a probability ratio that is much higher. And as long as you're picking your trades correctly in terms of the right inflection points, it really makes some very attractive sense. This is what I've been doing on a consistent basis with a round number, but there is also a couple of other sub-levels that really work very well on this type of a short-term setup. One key sub-level that really works well is the following. We have a reversal on the move, or basically, let's say we break the key OO level. If the currency pair then, in the near term, right after it breaks the OO level, gives up the 80, that means if you're trading 80 or below, or in this case, for example, 79 bid or below, there's a very high probability chance it's going to drift even lower into the 70s. So with the give up of the 80 level, it becomes a very good trade. So one of the trades I did is I took obviously the 4,300 to 95, make plus 5 points, and then I didn't get a chance to trade the retrace because it was just mayhem in the post NFPs and I was very busy. But then, and as the market sort of filters the reaction and markets come down a little bit, we move back through the 43, and now comes a true move. We give up the 80 level over here, as you can see, and you have plenty of movement to make it all the way down to at least 75, and of course all the way down much lower afterwards, without having the danger of being stopped out. So giving up the 80 level becomes a very profitable trade, because once those numbers go, I think what happens basically is that there's probably a tremendous amount of stops between 4,300 and 4,280. Once the 80s go, there's almost a capitulation by the bulls saying, oh damn, this trade is not going well, and you have a very decent chance of follow through into the 70s at least. Now, of course, on a massive move like you had in the euro dollar, you had much more continuation and much more further movement. That's sort of showing you very short-term trades in an extreme move. But on a day-to-day basis, where you have much less volatility, these kind of short-term 5-point minus 10 things tend to make a lot of high probability entries for you. And they add up. I mean, you do 5, 6, 7, 8 trades like this a day, you have a good chance of, in the end, after all the bounces, after the stops and the profits balance out, to make plus 20, plus 30 points in a very low stress way, because remember, you're only risking 10 points, so your risks are very, very small. And more importantly, the trades resolve themselves very quickly, usually within 5-10 minutes of the entry point. The other key thing about trading all of this stuff that's very important is that it requires some preparation. You clearly cannot simply be sitting at the charts and the moment that the price breaks the key levels, try to enter into the position, because the moment the price breaks those key levels, you're going to be too late in terms of entering into the position. It usually tends to just fall right through within 2 or 3 minutes, and at that point you're chasing price, and you're basically getting fills like let's say if you're trading the 00, you're getting fills at 97, 98, and you're minimizing your chances of success. A much more intelligent way of trading this setup is as the prices approach the levels, you set up a limit entry order into that trade. So for example, as it was approaching 43, I had a stop sell at 4,300, stop at 43.10, target at 42.95 on the 00 number. And similarly, when it came into the 80s, as it was approaching the 80 level, I had a stop sell at, and I generally like to stop sell one tick below the level. So in this case, it would be 42.79 with a target profit of 42.74 and a stop at 89. And by presetting the entries, you basically don't have to chase prices. The moment the prices hit, you're entering into the market. The stops, the limits, brackets your order, and usually the trade resolves itself within 5-10 minutes. So it's really kind of a very low stress way of trading. It produces nice short-term profits, offers you really good, interesting opportunities. And the key levels that I love to trade, obviously, is the round number both from the upside and to the downside, and the give back of the 80 level. Because once the round number goes, and then if the 80 level goes, there's very strong possibility of further filtration to the downside. I'll show you next week some of the upside numbers that I think I consider to be key levels that really matter, because if those things get broken, they typically usually mean further upside momentum on the move. So same ideas, but this is a great way of trying to profit from the stops of others. I'm wishing you the best of luck. This is Boris Schlossberg, over and out. Talk to you next week.